Welcome to the Armchair Trader podcast, and this week we are talking about the commodities markets, in which there has been a lot of action recently. Regular listeners will be very pleased to know that on the podcast this week we have Nitesh Shah, who is head of commodities and macroeconomic research from fund manager WisdomTree. Welcome to the show, Nitesh.
Thank you very much. It's a pleasure to be here.
So, no, it's great to have you because we've got quite a lot to get through today, and obviously there's been a lot going on in the commodities markets. Obviously, the big story, certainly this year, and indeed probably the previous year as well, have been the energy markets, particularly oil and gas. Usually commodities that only traders are focusing on, but the high prices have obviously fed into people's day-to-day lives as well. Speaking of the oil market and the recent OPEC meeting, do you think this is a commodity market that's still very much in charge as far as the commodities markets overall are concerned, and also the wider economy?
Yeah, I think what we're experiencing right now is very unique situation. We've got this energy crisis, which is really started with the conflict in Ukraine from Russia. With that, there has been plenty of barrels of oil that have been shunned from generally developed Western markets from Russia. So there's an adjustment process going on there. In addition, natural gas from Russia has almost down to a trickle coming into Europe, keeping that market extremely tight. So there's a big supply side shock that has resulted as a result of that conflict. But on top of that, we've seen OPEC's actions actually almost add fuel to the flame, right? They're actually cutting back on production. And maybe a little bit of context, and background will go well here. We started the COVID pandemic with demand collapsing. At that point, OPEC cut back drastically on production, somewhat belatedly after some initial infighting between members and non-members. But then, when they cut back on production, they managed to constrain supply quite considerably. And after oil prices initially went almost negative for the WTI contract, it bounced back significantly last year and the first half of this year as demand was recovering. But what we're facing right now is central banks across the world, well, not across the world, Japan and China are some exceptions, but most central banks today are trying to fight inflation and fight aggressively with rate increases and reversing the quantitative easing that they originally put in place. Now, that is risking a recession. Now, when recession risks present themselves, people are worried about demand for everything that's driving the economy, and oil and gas included. So with that, we saw demand starting to weaken in the second half of this year, or at least fears of demand weakening accelerate. And OPEC have been feeding on that. So when we started seeing some weakness in prices that started in June, OPEC have been saying, well, the price weakness is out of kilter with and price weakness in futures markets is out of kilter with the fundamentals of oil in the spot market. And that's why OPEC has decided to move quite big here. And obviously, OPEC is also facing an inflation problem, and it wants to get its revenues higher so it can feed its populations, provide subsidized food and things like that to its populations. So that's why OPEC has moved. But the size of his move is very meaningful. 2 million barrels per day of a cut, on top of what was already a fairly tight market, is very meaningful. And we've already seen month to date performance for, say, the WTI contract up close to 13%, which is a very meaningful move.
And obviously inflation, you've mentioned that already, big concern for, well, the wider general population, but also investors. Is it being powered by these high energy prices? Are they the big factor, or is there other things at work here as well?
Yeah, so it's a combination of things. But if you look at Europe, the biggest contributor to inflation today is energy prices by far. But food prices are also high, which is actually a chain effect from what's going on in energy prices, right? To grow food, grow agricultural crops, you need fertilizer, and fertilizer is a energy derivative, right? You make it from natural gas and oil products. So food and energy are very big here in Europe. But for a global picture, it's not the full extent. In the US, I think the demand source of inflation has also been pretty strong in that context of the Federal Reserve, the US Central Bank, having kept monetary policy quite loose for probably an extended period over there, and kind of belatedly coming to the party of sort of, or coming to the realization that it needs to tighten rates. Here in Europe, I would say there's a lot more coming from the supply shock of energy than the natural demand being extremely strong. Although demand is strong, and that's why the European Central Bank and other European central banks like the Bank of England and the Swiss National Bank, etc., are tightening rates at a very strong rate. Now, what I think is that these central banks are probably going to be surprised by how stubborn inflation is going to be, because they are, and I think a lot of the market is approaching inflation as that demand problem. That demand is too strong because of monetary policy having been too loose and fiscal policy adding to that. The failure to acknowledge just how big supply problems are, and the initial diagnosis of supply problems was that they're all transitory. Supply problems aren't just going to be transitory. We have reason to believe that problems are going to be prolonged and persistent. And part of that comes back to the COVID issue, right? COVID laid to bear just how complex supply chains are globally, and many companies around the world are seeking to make their supply chains less complex. That means localizing a lot of production. So even if the original supply chain that was damaged in 2020 is pretty much restored, that process of moving to a more simpler supply chain by onshoring or bringing things closer to home markets is still ongoing, and that will take a number of years, and that's actually adding to cost pressure. Additionally, pre-COVID, and and even before that, really, there was a very strong disinflationary force in the world, and that was China. China was integrating into the world economy. It was urbanizing at a rapid pace. And China is not doing any of that anymore to the same extent. And additionally, it wants to focus on higher value add rather than just being a manufacturer for the rest of the world for cheap goods, and bearing all the environmental cost of doing that. China wants to move up the value chain. So that disinflationary force from China being absent means that I think we're going to be structurally higher on inflation. So these central banks are going to struggle with that just by sort of raising interest rates. They're not going to be able to quell inflation. By raising rates very rapidly, they are likely to risk that sort of recessionary component. And this is all coming, as we talked about earlier, with energy prices as a result of a war being very high. So the hardship that is faced by households and firms is probably going to be quite large in this environment.
And for investors themselves, we hear from investors who, for example, are sitting out the market at the moment because they're just not feeling confident enough. At the same time, if they go to cash, the cash returns are not going to beat current inflation rates. Where can you go if you're an investor? Where do you go in this market right now if you're going to try and beat inflation and get those inflation beating returns? It's a really tough question.
Yeah, I think investors who are focused on traditional asset classes, equities and bonds, they would have had a very rough time, right? Both asset classes have simultaneously declined by very large magnitudes. Equities are cyclical, you expect that, but bonds, being the defensive asset, you would hope would do better. But bond yields have shot through the roof, and if you live in the UK, we've just been living through absolute disaster when it comes to the fight between monetary and fiscal policy, and bonds being a huge casualty in that. But that's if you're only focused on traditional asset classes. Commodities, however, have actually provided very strong year-to-date performance in the region of 20% plus. Yes, commodity prices have weakened a little bit in recent months, but if you are looking to hedge inflation, And bearing in mind where the sources of inflation are today, it's clear that commodities provide a very strong hedge, because a commodity basket will have energy prices, well, have energy components in terms of oil and natural gas, and it would have food correlation through all the agricultural commodities that are included in the commodity basket. In fact, our analysis just shows that commodities, looking back at data going, spanning back decades, has the highest inflation beta of any asset class. In fact, it's so what I mean by beta is sensitivity to inflation is very positive. So when inflation goes up, commodity prices go up. In fact, equities, even though they're cyclical, generally tend to fall when inflation goes up. So and that's the same case with treasuries as well. They tend to fall when commodity prices rising. Now, a more interesting point is when we have tried to separate what is expected inflation and unexpected inflation. Expected being something we proxy just through the T bill rate, so the prevailing interest rate should be somewhere where markets are expecting inflation to go. But the unexpected components are what we take actual inflation minus that T-bill rate. The beta for between commodities and unexpected inflation is even higher than the expected inflation. And no other asset class is like this. And I stress, we're living in a world right now of inflation surprises. Only commodities are capable of hedging against those surprises. We've done the same sort of analysis between for treasuries and the expected unexpected inflation. And treasuries actually do have a positive beta for the expected inflation, but the unexpected is negative. So if you want to endure this world of inflation surprises and shocks, commodities are possibly the best place to hedge.
Talking about that, there are obviously a lot of investors looking for wealth preservation, capital preservation in this environment. They're seeing that getting eroded by inflation. As I've already mentioned, cash possibly not the best option right now, although rates are going up. Gold has always been that sort of traditional place to go. I mean, some people obviously go to the Swiss franc, but gold was always touted as that market that you went to when this kind of thing happened. And last time, inflation was like this, I think it might even have been before my professional career started. So this is kind of new territory for a lot of investors now. Is gold still that sort of reserve you can go to during a high inflationary environment?
Yeah, great question. And what I would say is gold is a fairly complex asset. It's less like a commodity than any other commodity. And in fact, I would say it's more like a foreign exchange. It has many traits of foreign exchange. It's used in a sort of monetary capacity for several millennia, but it's very different to what we call fiat currencies like dollar, yen, etc., in the sense that no central bank controls its supply. And that's why a lot of investors like gold, because its supply can only be increased at the same rate at which mining activity occurs, which is quite constrained. So when we saw, the balance sheet explosions from the Federal Reserve, the ECB, Bank of Japan in the early days of COVID, you could see that gold prices rose substantially as that alternative to these currencies that were being debased. So there is that wealth preservation factor. But, we're past COVID now, the worst of COVID, hopefully. And, in the last year or so, yes, gold prices have declined. Now, once again, I would say gold is that complex asset class, and to demystify some of that complexity, we have developed a model for describing gold price behavior. And from that modeling work that we've done, it's very clear that gold is related to treasury yields. So as treasury yields rise, as in bond prices fall, gold prices tend to fall. When dollar rises or appreciates, gold prices tend to fall. When inflation rises, gold prices tend to rise. And when there is investor enthusiasm regarding gold, investor sentiment arises, and we measure that using speculative positioning in gold futures, gold prices tend to rise. So that those four things pretty much can really describe most of gold price behavior. Now, if we look at those things in turn, bond yields are shot through the roof. Dollar has appreciated to a 20-year high. So there's huge headwinds facing gold. So even though inflation is at multi-decade highs, it's fighting these other two headwinds. So net net, yes, my model does indicate that there should be downward pressure on gold, despite the fact that inflation is this high. And in fact, gold has actually performed better than what my model would suggest. To put it in the context, in the month of September, my model would have indicated that gold prices should have fallen in the order of 20% year on year, whereas it only fell around 5%. So what's happening is that there's some other factors that are helping support gold right now relative to those four things that are predominantly driving gold prices historically. And what we are seeing some huge strength is in the physical markets. So if you look at to China, there's lots of demand for gold right now because gold's trading at a premium in China. There's also all this recessionary risk. Once again, gold performs well in recessionary times, and therefore, with the bond yield curve inversion, which often indicate, is a precursor to recessionary periods, there is that little bit more support offered to gold in this environment. And once again, it's all centered around the way gold is viewed as a wealth preservation tool. And so it is kind of living up to that, although it's facing very severe headwinds at this point in time.
And I mean, we have a model portfolio. We have several model portfolios, but one of them is long gold and has been long gold for some time. Rationale for that is partly because during the great financial crisis, gold didn't really rally substantially until much later than the actual dislocations that we saw in the financial system. But there was a big bull market for gold and silver. I think it was 2010, whereas the original crisis started at sort of the back end of 2008. Do you think there's scope for something like that? Or do you think that gold is actually, relatively speaking, more expensive than it was then? And that kind of, I know there's always a bullish analyst will come out and say, oh, yes, gold is going to, $2,000 an ounce or even higher. I've seen some crazy forecasts out there. Or do you think that's just unrealistic? I'm just thinking now because we're seeing some dislocation in the credit market as well. Maybe not on the scale that we saw in 2008.
Yeah, I think there's plenty of potential for gold to go higher. Uh, as you say, the gold isn't like it's not a leading indicator. It's not even a coincidence, in terms of rising when the stress rises. It tends to rise a bit later. And usually, when it's obvious to see that there is a recession on the ground, and there is physical, you can visibly see the hurt in the economy. Right now, we're talking a lot about recessionary fears, right? I know US is technically in a recession, but it's not in a recession by broad measures like unemployment. Once you start to see stresses in the labor market in the US, and once you start to see the visible pain that the energy crisis is really inflicting on households in Europe in the wintertime, I think there's a lot more movement towards gold we'll see. And already in the physical markets, that enthusiasm for gold has already picked up.
I wanted to move off, well, slightly off commodities now and talk about the energy transition. This is obviously the process that we're seeing underway now, where governments and companies and even the energy giants are focusing much more investment into alternative sources of energy away from the obviously expensive oil and natural gas markets. It's obviously a very complex market. The level of take up differs from country to country and region to region. From where you're sitting, where do you see the bright spots in this market? For example, there's a lot of talk about wind power, solar power, large scale energy storage. I mean, what's your take on it?
Yeah, I think the key thing to note is the climate targets that are legally binding are pretty ambitious, and the policy dynamics today are nowhere near matching that ambition. So we've got a big disconnect. Policy will have to tighten up and tighten up rapidly. Today, at a continental level, I think only the European Union has only been sort of one of the kind of regions that are really acknowledging that big shortcoming. their ambition is to reduce greenhouse gases by 55% relative to 1990 levels by the year 2030. But there are calculations show they can only get to around 40% on the current course. So they're trying to plug that gap, and they've come up with a legislative proposal. I think a lot of other countries around the world would have to come up with these sort of things. But what is clear from when you analyze where the gap is and how to fill it is you need everything. You need to throw everything at it to get to where we need to be. So it's a lot more solar, a lot more wind, a lot more geothermal, even natural gas, which is a fossil fuel, will be needed because it's less carbon intensive than coal and oil, and is therefore needed as a transition while you're building everything else out. On top of that, you need hydrogen electrolyzers. And what we know is all of these things are infrastructure heavy. They require lots of metals to build out. And even on the downstream side, not just producing the energy to start off with, but how you consume the energy. For example, in cars, internal combustion engine vehicles clearly don't cut it. Electric vehicles are a fraction of the life cycle greenhouse gas emission of internal combustion engine vehicles. Once again, they're very metal intensive. At least 3 times as much copper, and you need nickel and cobalt and all these things that don't even exist in regular cars. So the way we see energy transition, if you're trying to play this, metals are the place to go. And guess what? Metals are in a bargain right now. Their prices have been falling quite drastically during the course of this year, and the inventory of metals are very very tight. So we see metals as a really sunny spot in terms of how to play the energy transition. In addition to that, we believe that all the technologies that propel energy transition are looking good. So if we think about energy storage in terms of storing the energy that's produced from renewable sources, because it's a very variable production, batteries are needed for smoothing that consumption demand balance, but also they're needed in cars. So anything that's present in the battery value chain, we think is really great. One key thing that's possibly ignored by many people in that is recycling of batteries. Recycling is a very, very tiny market right now, and is going to grow to something very big because that circular economy is going to be needed in the battery world. So that's possibly another one area. But I could go on this topic for probably hours. So I mean, but I'm happy to do so. But if you want to pose another question, I'm happy to take that too.
Do you think there's enough political support coming in the UK and other European governments for the green energy revolution, or do you think more needs to be done?
Clearly, more needs to be done because as I mentioned, the policy goal is here, policies in place are here, the gap is wide, and the time to deliver on that isn't very long either. Building out infrastructure for this energy transition takes some time to do. Right now, carbon emissions are rising rather than falling, and generally, the European Union's success in reducing its carbon emissions is simply being to stop making things in Europe and import it in from China. So the carbon is going up elsewhere. So the gap is very wide. Right now, the energy crisis has thrown a bit of disarray into the policy formulation. We've seen in the UK sanctionings of of coal and gas and oil production, which goes counter to the energy transition that has been hoped for. And it's a little bizarre because building the infrastructure for all those things just takes as long as building the infrastructure for wind and solar, etc. So it's somewhat misplaced, I think, some of that movement there. Also, in the European Union, you've got repower discussions, repower EU discussions, which are the conversation or the aim to wean off Russian hydrocarbon energy sources. Now, within that, there's a lot of stuff that's propelling energy transition because that's part and parcel of that. But also, there's been a bit of softening up of things as the European Union is desperate to get hold of energy molecules from any other source. So there's a little bit of a mixed bag going on in the European policy. Right now, repower is dominating parliamentary discussions. That will move quickly to Fit for 55, which is bringing down to that 55% greenhouse gas emissions reduction. Once that starts to take place, I think we'll go back onto course in terms of getting more policies that are conducive to the energy transition.
If you think about it, there's got these big energy companies are obviously now starting to invest more heavily in their green energy strategy as well. From the perspective of an investor, do you think that these kind of companies will provide quite a lot of exposure to this new green energy story, or do you think it will be more a case of new companies, new up and coming, probably mid caps at the moment, that will become the new energy giants of the future as this technology feeds through, just as some of these original oil giants were created back, in the 1920s and 1930s when the fossil fuel boom originally started.
It's a great question, and it's very hard to predict how quickly these companies will pivot and place emphasis on newer energy versus old energy. So far, what we have seen is the likes of Exxon and Royal Dutch Shell. The reason for being more present in energy transition and developing a net zero pathway has been more because the courts have forced them, or you've had activist investors pushing that agenda. So it doesn't seem like the most sort of genuine and natural transition from their standpoint so far. They've been more forced to do it, but it may be at some point it may drive an epiphany, right? They may realize that this is where the energy world is going, and holding on to the existing assets and investing heavily in those existing assets may leave them behind in the world that we're entering into. A lot of the energy giants have been disposing assets, traditional assets, and doing share buybacks and things like that. But their rate of investment in some of the newer clean energy assets hasn't been matching what they've been disposing as well. So at the moment, it looks like I think newer players who have a genuine interest in developing the technology and progressing that market will be the key players of tomorrow. But you never know. Some of the traditional players may start to pivot at a faster rate, recognizing what's at stake.
And finally, I just wanted to ask you about, we've talked a lot about energy on this podcast already. We have touched on gold and metals. Do you think there's any other commodity markets from your perspective that have been doing well or seem poised to do well this half?
I think all commodities generally have their sort of micro stories. I touched on it earlier on, but agricultural commodities, because of their close connection with energy through the fertilizer channel, for one, but also a lot of agricultural commodities are used as a feedstock into biodiesel, biofuels. So, with the energy demand propping up the grain demands or the sugar demand or the agricultural product demand, I think agriculture has some strong tailwinds there. Also, it's affected by the war in a more direct way because Ukraine and Russia are the breadbasket of Europe. There is a grain deal right now that Russia has offered to for the safe passage of grain out of Ukraine, but it's increasingly looking like that will lapse beginning of November with the escalation of that war in recent weeks. But in addition to that, we are facing a La Nina weather pattern. And what I mean by that is there's a body of water in the Pacific. When it cools below a certain level, it changes world trade wind patterns. And when that happens, weather is affected. Some places that are supposed to be wet become dry, places that are supposed to be dry become wet and cooler. And that causes problems with growing crops, so yields can be affected as a result. So agriculture is a clear area where we see some optimism, especially after recent pullback in prices in recent months. We talked a little bit about metals, and obviously that's more of a longer term story for the energy transition. But on the ground right now, today, what we are seeing is most metal inventory is significantly below average. And talking about sort of with nickel and aluminium, inventory on the LME is close to 70% below its 5-year average. So right now, while markets are focused so heavily on demand destruction from recession, what's on the ground is a picture of a much more tightness. When the market recognizes this, I think there'll be a potential for quite a substantial price increase, especially as short positions in those metals unwind.
Fantastic. Well, thank you very much indeed, Nitesh, for coming on the podcast this morning and giving us some of those insights. It's really good to get your perspective on commodity markets, and hopefully get you on the podcast again in the future to brief us again once we've seen some of these developments play out.
Thank you very much. It's been a pleasure.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.